Do you have a tax-free savings account, also known as a TFSA? Or maybe you're thinking about getting one. You might be wondering, how does it work? Advantages, disadvantages, common mistakes. Well, you're in the right place. Today we're going to talk about the TFSA, how it works, and we're also going to talk about the common retirement mistakes to avoid that I've seen for my clients, prospects, and just having general conversations about TFSA. So, without any further ado, let's get going. What is a TFSA? So, a TFSA is a registered account. It allows your money to grow tax-free, which is a huge benefit here in Canada. There are not many vehicles that allows for money to grow tax-free. And even if that asset within the TFSA is incurring what's typically treated as income, dividend, or capital gains, beautiful thing is still treated tax-free when withdrawn, right? So here's the thing. It's also very versatile. And some folks will use it as a savings account. Some will use it for, investing. Some use it for retirement planning. Different purposes, right? We're not going to talk about all different purposes today. We're going to focus on retirement. So just know that it's very flexible, and the use, depending on your circumstances, may be beneficial. TFSAs, how do they work? Well, you have an annual cumulative contribution limit, and an annual amount as of today, October 2023, is $6,500 annually. If you have unused contribution room, that gets carried forward. So if you're qualified for a TFSA since 2009, the cumulative amount that you have in terms of room this year is $88,000. Now, what do you need how do you qualify for a TFSA? Well, you have to be a permanent resident here in Canada. Now, it's one thing to note that what's tracked in terms of your contribution room is how much you actually put in the account. So if you put 50,000 in and it grows to say 80,000, 90,000, that does not take away from your room. Your contribution room is based on a dollar for dollar how much you put into that TFSA, not the growth. So just make note of that because some people mistake that. Another thing is if you want to withdraw the room that you have taken out, gets added back to the contribution room the following year. So for example, this year you have contributed up to this point $88,000, October 2023. In December, you've decided, start of December 1st, I'm going to withdraw $5,000 because it's Christmas and I want to buy gifts for my employees, co-workers, friends, families, etc., etc. You pull $5,000, right? So now your contribution room has opened up because you pulled $5,000 in, pull $5,000 out. That $5,000 cannot be contributed until 2024. Once January rolls around, you'll be able to do it then. But you cannot take out $5,000 December 1st, and then if you have no other room left, December 31st, you decided, you know what, I just got my bonus, and I'm going to want to put that $5,000 back. No, you can't. If you're maxed out to $88,000 in December 1st, and you pull that $5,000 out, you have to wait till January 2024. So that's another thing to remember in terms of how TFSAs work. Now let's talk about some mistakes that I've seen. The first mistake is underutilizing the contribution room. The beautiful thing about this is your money grows tax-free. So why wouldn't you want to take advantage of that? I've seen far too many people come to me as it gets close to retirement, and they're thinking, okay, what's the best way I can structure my investments? And you see all of this money either sitting in a non-registered or an RSP, or sometimes just in plain cash. And they're wondering, okay, where can I put this money? And we structure it and we implement things, but what they've lost is they lost the ability to have their money compound over decades in many circumstances, right? So they lost the opportunity to have tax-free growth over those many years. So that's the first one, is underutilizing contribution room. Now, when you set up a TFSA, one of the first things you're going to ask you is, do you want to have a beneficiary, or you want to set up a successor designation? Okay, so what's the difference between both, right? And just so you know, a successor designation, that comes about when you name a spouse or common law partner. Can be your friends or kids or whatever. It has to be a spouse or common law partner. The way I look at it is, a beneficiary is the person who gets the money, and a successor designation is the person who gets the account. right? And you might be wondering, okay, so what's the big deal? So if you're partners and you've both maxed out your TFSAs and one partner happens to pass away, and if the surviving spouse is labeled as the beneficiary, that amount cannot then go into the surviving spouse TFSA because they would have been maxed out. But they can get the money tax-free, but now they'd have to allocate that money into an RSP, a non-registered, or invested however they want to invest it, right? However, if you have a successor designation, here's the difference. That account, even though your surviving spouse has maxed out your TFSA, the surviving spouse still gets to take that account, and that account continues to grow tax-free and treated as a TFSA. So you still get the benefit of the tax-free aspect of the TFSA. And that's a huge benefit, especially if you're maxed out your TFSAs as a couple. So that's the first one. That's the second one, overlooking successor designation. The next one is mismanaging withdrawals. Here's the thing, as it relates to retirement, I always speak about this. The big challenge with retirement is that, before you have one source of income, in retirement you have several sources of income: pensions, personal pensions, government pensions, RSPs, OAS, CPP, TFSAs, non-registered. Depends on your investment situation. It could be from a lot of different incomes. You might still have a business, still get money from your business, right? Dividends from all these different things, royalties if you own books. It's just coming from all these different places, and depending on how you take that income, you're going to be taxed based on your different sources of income. Now, if you're getting government benefits, that's also huge, because depending on your income, that could potentially lead to clawbacks. Now, if you have TFSA, what it allows you to do is top of the year, end of the year, what I do with my clients. So now it's approaching December, November, December, start sit with my clients, and definitely top of the year sit with my clients who are in a retirement phase of their life. And we look and we say, okay, how much do we need for this year? And what are all the different sources of income? And we strategically decide where we're going to take that income from. So it allows for huge benefit. Now, if you kind of haphazardly just pull from RSPs, you're gonna treat it tax as ordinary income, or one year you pull a significant amount from your TFSAs because you don't want to pay taxes, but you haven't think about the long-term effects of that. It's gonna potentially cause some challenges in that tax planning aspect. So if you just withdraw without being strategic, that's a huge potential mistake there, especially in retirement, because a lot of people, especially relates to RSPs, they contribute to RSPs when you're a higher point of income. You take that deduction, and the whole goal is to pull from your RSPs when you're in a lower part of your retirement, and you're earning, you have a lower income, and so it's going to be taxed at a lower rate. But if you're not being strategic, who knows? You might even be taxed at a higher rate than the amount that you earned it, right? But TFSAs help to be that buffer, because all the money that you get from a TFSA is treated as, it's not treated as taxable income. And so potentially you're receiving cash, but you're not taxed for it, right? And if you have government benefits that are based on your income, that also allows you to be strategic. Because if you're going to potentially have clawbacks or maybe even lose certain benefits, what you can do is use TFSA as, use it as a buffer, where you're still receiving cash, you're still receiving money, but the money you're receiving is not treated as ordinary income, which allows you to retain some of those government benefits. So that's a huge thing, mismanaging withdrawals as relates to TFSAs. Next one is neglecting investment opportunities. I talk about the flexibilities of TFSAs, but a lot of people, unfortunately for the name, tax-free savings, we have a whole bunch of money in a savings account, not getting a lot of interest rate, and not thinking about long-term potential growth, because they may not know, and I've seen a few people in this situation, they had no idea that it could be used for investment. They thought it could only be used for savings. Well, folks, if you didn't know, today you know that you can put stocks, bonds, mutual funds, the different investments that you could put in a TFSA and have that grow and earn substantial, depending on investment opportunities, substantial growth, and that all be tax-free. It doesn't have to be treated like a savings account. So that's the fourth mistake I've seen. with TFSAs. The last one is failing to replenish withdrawals. So another thing is, things happen, circumstances happen, and sometimes it makes sense. You have to pull from a TFSA, and you pull from a TFSA, and you may if you have a PAC pre-authorized check-in withdrawal where you're making monthly contributions, you just keep that going, but you don't think about replenishing that amount that you've taken out of the TFSA, and you probably put it in other different financial vehicles when it would have made more sense to put it in a TFSA and continue to grow. So that's the fifth one that I've seen, failing to replenish withdrawals. And sometimes it's just an oversight. Sometimes it's, not being on the ball. If you have a financial planner, your financial planner definitely should be looking at this and encouraging you and helping you to put that in place. So that's the fifth mistake. Hopefully this was helpful. If you have any questions, leave it in the comments, share, subscribe, and like, and I will see you soon. Take care.